All right, so for today, as I said, what we're going to focus on is in Elms, there's a folder called SBUX, and there are two files that we're going to begin with. What we're going to do is we're going to be building a reusable valuation model, which is tied to Bloomberg, right? And it's going to be a standardized model. Over the next 2 weeks, this week and next, we're going to build out a valuation model for the company SBUX. All right, we're going to do a valuation. It'll take us a week and a half to build out the SBUX model, right? Then you're going to use this model to do value another company. It will take you 10 minutes to do company number 2. Okay, so this is what I mean by a reusable model. And this is the model that you're also going to be using for your group projects. So very shortly, I'm going to give you an industry. You're going to select a company within that industry to value. This is the model that you'll use. You'll be individually building this model. There's no sharing of models. All right, so you have to complete the model yourself. So in class today, we're going to start building the model. Your homework, which is due on Wednesday, is to submit identically the model that we build in class today. So you must follow in Excel and get to where I finish at the end of class today. This is being recorded. It'll be posted on YouTube, but you must basically submit that file by Wednesday at the start of class. Yes? You won't be pulling it in live regardless of where you work on it. So it doesn't matter whether you work on your laptops or the desktops in the room. Sure. So you will basically submit that file, and then on Wednesday, and I will not give you a solution on Wednesday, you will take that file and we will continue on. So that by next Monday, you'll submit the final part of the valuation. So over the next 2 classes, we're going to build out the model. Right? Half of it will complete today. You have to submit that. And then the other half will complete by next Monday. And then Wednesday, we'll finish up the valuation of SBUX. That is our plan. Okay? So, continuing on. Let's start out with Bloomberg. Okay. Kill this file. All right. So if you open up the file, SBUX data, and if you open up the file, valuation model start, what you'll notice is that the first tab of the valuation model, and I call it start because that's where starting for SBUX, is basically the same as the SBUX data file. Okay? So the way the model works is the tabs go from left to right. It's actually very similar to what you did on the midterm. So on the midterm, you took historical financial statements, and then you created TII, TFI, CFI, EP. Well, I've done the same thing here as a starting point for you. So here are the historical income statements and balance sheets for SBUX. Here is the TFI, the TII, and the CFI, and the economic profit already mapped, already converted, just like you did on the midterm. Okay? So I'm starting essentially with the process that you did in the midterm. I'm just shortcutting the work so you don't have to do this part yourself. I've done this part for you. Okay? So here's the thing. In order for this to be a reusable model, we need a standardized income statement and balance sheet. Okay? So that's what I've done here. I've put in effect, a standardized income statement and balance sheet for SBUX. But I want to use this model for any company. So we're going to get the data for these companies from Bloomberg. So here's how we're going to do it. If you go to Bloomberg and you go to any company, so again, SBUX, and you type in FA, FA is the historical financial statements, right? So for example, if you click on the IS tab, these are the historical income statements for SBUX. But what you'll notice, and this was very frustrating by the way, is up to 2 years ago, Bloomberg actually used to have a tab called Standardized. And what they did is Bloomberg standardized the income statement and the balance sheet. But 2 years ago, they changed that. They took away their standardized statements, and they replaced them with these adjusted statements, which unfortunately are not completely standardized. So They work for some companies, but they don't work consistently for every company because sometimes the fields are a little bit different. And that causes a problem when we try and do a standardized model. The GAAP statements also are not standardized because accountants don't want to standardize anything. And the as reported are definitely not standardized. So there's variances slightly in terms of names or locations or number of items reported across the companies. Well, we can't have that in a standardized Excel model. So we're going to go to the Custom tab. And what we can do in the Custom tab, and we'll create a custom template, which is going to be part of your homework assignment. So you are going to have to do what I'm starting to do here, is in our model, under model data, and you can see this here, are basically going through row 80, 74 fields from the Bloomberg database in this particular order that I mapped from Bloomberg to this custom data set, so that the income statement and the balance sheet in this Excel file pull from these custom fields that were exported from Bloomberg. Okay, so that's the point. Since Bloomberg doesn't standardize these statements, what we're going to do is we're going to take the Bloomberg fields and we're going to create standardized statements in Excel. But in order to do that, we need to pull the data from Bloomberg in this format, more importantly, in this order. So every one of you in your Bloomberg terminal will need to create a file to export this data in this format as part of your upcoming homework. So how does that work? I create a custom template under FA. I have two ways to do this. So the first field is revenue. Okay, so I can type in revenue, and there it is. That is not the preferred method, because what really matters is if you hover over revenue, you'll see the actual Bloomberg field name, which is sales _ rev _ turn. And unfortunately, there's the field name, by the way. I need the exact field. And sometimes Bloomberg has similar names for similar things, which are two database fields. And I might choose the wrong one by mistake, which is going to screw up your model. So the preferred method number 2 is I need these exact fields. So for cost of revenue, this is the easier way to do it. Take the field in the Excel file that I've given you, copy it, go to Bloomberg in the field, paste it, and then select it. That way, you know you have the exact right field. Okay? So if you take the actual database field name, put it into the enter field, and then select it, then it will give you the right field. So what you're going to do is you're going to do this 72 more times, and you're going to create those fields in this order. And then you're going to save your template. So here's mine. I named it model. You can call it whatever you want. But you're going to basically create this Bloomberg template called model. Right? And this is what we're going to export to Excel, which is going to give us the data for the companies. Now when we export to Excel, we're going to have to make a few adjustments. So we're going to go to the settings. And one of the settings under the Fundamentals tab is we want to use 6 historical periods. I believe it defaults to 10. We want to change that to 6, right? Because arbitrarily we're going to use 6 historical years, right? And we're going to forecast 6 forecast years instead of 10. So make sure you change that to 6. On the Data sub-tab, all these extraneous data fields, uncheck. We don't want to put any more data in the Excel output than the 6 historical data fields. So just make sure that all of those are unchecked. None and none. Yep. And none of the data fields checked. All right, because we just want clean data. We don't want any other analysis on the data. It will cause problems when we export it. Display. Make sure ascending, because we want to have the oldest year on the left and the most recent year on the right. If you do descending, the most recent year will be on the left. It'll cause you problems. So make sure it says ascending order. And then finally, under Report Excel, make sure Excel export as value. All right? Because if you export as formula, what will happen is when you export it in Bloomberg, it'll actually give you the database lookup. And then every time you open up Excel, it'll pull the data down in real time from Bloomberg. However, when you leave the lab, it's going to cause a problem. Because when you're at home, you won't be attached to Bloomberg, and it will error out your file. And when you submit your homework, which will grade it without Bloomberg, will then see an error in the file and you get a 0. So you can't export values. You have to, formulas. You have to export values, which are numbers. So make sure it says value, right? Then update this. So save it in your Bloomberg account. The next step is once you've done all this, then what you'll do is you'll output to Excel. And so it'll take this template that we just created and it will put it into an Excel file. Okay? And while I was doing the output, this is the file which I called SBUX data, which I put onto Elms. Okay? So for your purposes, you basically need to recreate this. Okay? So I've already done it, so we can complete what we're going to do in class today. But here's the thing. Let's say the next company is Chipotle. Right? So what you're going to have to do is you're going to have to replace SBUX with Chipotle. So you just basically put in Chipotle, FA, custom, the template you just did, export Chipotle, put it into the model, boom, we got a reusable model. Okay? And this is what I mean. Then you do it for Ford. Then you put Ford's data in. Okay? So we'll be reusing this throughout the semester. So this is very, very important to be able to do once we get to next week when we get beyond SBUX. All right, so this is a homework assignment that you're going to have to complete. All right. One last thing. When you do export it, and I don't know a way around this, if anybody can find one, please let me know. But these dashes, when Bloomberg has a 0 or a missing field, sometimes it'll put dashes in the database. Excel chokes on dashes in a formula. If you put a formula with a dash in it, Excel will just give you an error, and it won't actually complete the calculations. So we have to replace the dashes with zeros. Okay? So the final step, it's a manual step, I don't know how to get around this, is to Control F, find, actually copy the dashes is the easy way to do it. So Control C, Control F, find, paste in the dashes, replace them all with zeros, and replace all. You do it manually, it takes kind of annoying, but the point is you got to get rid of all the dashes. Right? Then File, Save As. In this case, I called this the SBUX _ data file. Okay? And that is the file here on Canvas. I just did it earlier today. Okay? So the next step would have been to take this file, the data file, and put it into our model. So the way that would work is, if here's my model, and here's my data file from SBUX, I select the whole model tab, copy it, I come into the start file, select the same tab, paste special values. Again, you don't have to do this. I've already done this for you, but that would have been the next step to reuse the model. Okay, put in the company's data that I just exported into the valuation model. Okay, so here's the thing. When you do that, make sure you paste special value across worksheets. Don't copy paste. If you copy and paste across Excel worksheets into two different models, what will happen is Excel will create a reference to that first model. And every time you open the file, it'll say, where's that other file? And it's just frickin' annoying. So don't do it. So what you need to do, if you copy paste special values, it just puts in the values, and it doesn't have to worry about references to other files. So recommendation, we copy across spreadsheets, right? So nonetheless, our model data, these 80 fields, create this income statement and balance sheet common tab, which then creates the TFI, TII, CFI, and economic profit statements, right? So that's the model, right? Now, the next thing we're going to do is evaluation. So we have to forecast the future. Again, I put up a lecture note today, which I'm not going to go through. I assume you read the book and you're up on what McKinsey said we have to do as a process. So following on that, we're going to do arbitrarily a 6-year valuation model. Okay? I'm not saying that's the right answer, just for simplicity. We're just going to do 6 years. 5 years of defined value, which means year-by-year forecasting, and then year 6 will be the beginning of the continuing value period. Right? Companies last forever. We have to value companies forever. So we will use the key value driver formula as the growing perpetuity for the key value driver, for the continuing value period. So you always forecast a n+1 when you do a valuation. That came right out of the book. And so in this case, the n+1 year is year 6, which is the continuing value period. So we'll manually forecast years 1 through 5. Year 6 will be the n+1 period. We'll use that data as part of the key value driver continuing value equation. Right? So the next thing as a best practice that's going to matter is we don't want to forecast individual numbers. What we want to do is we want to forecast ratios. Right? So the ratios give us a better forecast than giving the numbers. So that's where this ratio tab comes in. So the ratio tab right now has historical ratios. Excuse me. And it goes from 2011 to 2015. These are the ratios off the income statement and the balance sheet. Everything is a percentage of sales with the exception of revenue growth rate based on Starbucks historical information. So what we're going to do is we're going to use the forecast of the ratios to create the forecasted statements. That's the best practice. And then there's a final tab I want to mention. It's called the Assumptions tab. So we're going to also have some assumptions that are general assumptions we'll use in our model. They're on this tab. You'll notice that these cells have yellow in them. I've arbitrarily chosen the color yellow. You can use whatever color you want. But yellow basically means it's a cell that I can change, right? Because when I start making changes to the model, particularly when I use it across companies, I don't want to accidentally break a formula that I'm calculating. All right, so I want to be very careful about which cells in the model I can actually change. So I'm using color to basically help me identify if it's yellow, then it's something I can change. If it's not yellow, I should leave it alone because it's either a relative reference or it's a formula. Okay, so these are the cells that we will be changing over and over again. Also, a final best practice, we want to minimize the places where we make changes in the model going forward. Because when we reuse the model, if we put our assumptions all throughout the model and we forget to change one of those assumptions, it could really screw up our valuation. So therefore, we're going to minimize the places where there will be assumptions to 2 tabs, ratios and assumptions. We don't want to change anything anywhere else in the model, so it will be less complex when we reuse the model. So assumptions will be miscellaneous assumptions across the years. Ratios will be ratios for the forecast years. That's where we'll make the changes. So let's start building out the model. So as I said, your next homework is to do what I'm about to do. If you complete this at the end of class, you've completed homework 7. You can then just upload it. Is that homework 7? Is that the next one is? Whatever homework it is. I think it's homework 7. You basically take this model, upload it, done. We'll pick up here Wednesday at the beginning of class with what we've completed today. All right, so let's go ahead and get started. Ratios. I'm going to hide some of these columns just to make it easier for you to see. You don't have to do this. But I want to use relative references. So, equals previous year plus 1. Okay? And we're going to do 6 years. So I'm going to copy and paste this out to 2021. Notice I didn't hard code in the years because when Starbucks reports 2016 data and I change the assumptions to say the first reported year is 2016, I want all of these fields to update automatically. So don't hard code in numbers. All right. Forecast. We need to forecast revenue. So here's what we're going to do. As a placeholder, last year's revenue growth rate was 16.5%. So for now, we're going to say, what if they grew 16.5% again? And again, I'm going to make that a yellow cell because that's going to be something we'll change later, right? So as I said, I'm just going to use equals the previous year as a placeholder as we're building the model. Later, once the model's built, we can go in and put in more accurate forecast of what the revenue growth rate will be. So here's the thing. If Starbucks were to grow by 16.5%, then on the income tab, and again, I'll hide a few years, then for my forecast period, equals previous year plus 1, then my revenue is going to be last year's revenue for 2016 times 1 plus, from the ratios tab, the revenue growth rate for 2016, ratios H2. And I will format currency 1 decimal place. All right, so here's the point. If Starbucks grows by another 16.5%, then the revenue would be 22,325.7. This is what I mean by best practice. Instead of forecasting 22,325.7 directly, what we do is we forecast a growth rate. It creates the number. Now, I don't want you to do what I'm about to do, but just to show you where we're going with this, later, if we were to say, oh, what if they only grow at 11%? Well, then the income statement would represent 11% growth. Oh, what if I think they're going to grow at 18%? Well, the income statement would reflect an 18% growth rate. Okay, so that's the point. The ratios drive the statements. And what you do is you get a better forecast when you forecast the ratios. So that's the process that we're using that McKinsey talks about in the book. Okay, so for now, since I want us all to have the same model, I want you to have equals the previous year as a placeholder. So we all have the same starting point. So don't put in 18 or 11 like I just did. All right, questions so far? All right, continuing on the income statement forecast. You'll notice in gray, because these are the more important numbers to forecast for the valuation, the next gray number down here is Ebitda. Now, we're going to have to forecast Ebitda. 2 ways to do it. One, we could forecast cost of goods sold and SG&A, which would get us to Ebitda. But what I found is that it doesn't matter. Meaning, what matters is the Ebitda, not the forecast of the cost of goods sold and the SG&A. And for undergraduate classes, particularly what I found is you spend a lot of time creating an Ebitda forecast that doesn't really add a lot of value to your model. So to simplify it a little bit, rather than figuring out the cost of goods sold and the SG&A and how they're going to balance to an Ebitda, we're just going to forecast Ebitda directly. Okay? So basically, equals previous year Ebitda. We'll make that yellow. So we're not going to forecast these 2 items. Next, depreciation and amortization equals previous year. We're going to forecast depreciation and amortization. All right, doesn't change too much for most companies over time. We've already seen that in the ROIC trees we've been analyzing. But nonetheless, we'll forecast depreciation and amortization so that we forecast an operating profit. Except rather than directly forecasting the operating profit, we're creating the operating profit forecast because we forecast these other 2 numbers. So, Ebitda minus the depreciation and amortization is operating income. Again, not yellow because that's a calculated result. All right? So again, I'm making a choice in this model to forecast Ebitda to create the operating income rather than forecasting operating income directly. All right? So Ebitda and DA create the forecast for operating income. Questions about what I've been doing so far? All right, next we need to forecast the tax rate. So one thing we can do is we can look at the tax rate for the last 6 years, and we could probably just average these out for most companies. But would that work for Starbucks? If we did an average of the last 6 years, do you think that's a representative tax rate? Yeah. Yes or no? No. Why not? Because 2013 was 104%. So it's obviously going to distort the average. So one thing we could do is we can get an average without the 2013 in it. So take like a 5-year of the 6-year average. Or we could do something else. But that's the point. We're going to have to come up with a realistic tax rate. As a placeholder, as we're building the model, right now, we're just going to say equals the previous year. Now later we will change this, but for now as a placeholder, I'm just going to have it equaling the previous year with the assumption that we will create a more realistic tax rate for Starbucks on a go-forward basis. Right? The next line item, I'm going to go back to hiding some of these, again, just so it's easier to see what I'm building here, is no plat, which is a calculated result. In fact, you can see in cell G10, it's our operating income times 1 minus the tax rate. So if you don't want to type it out, copy and paste that. That would be your no plat as a percentage of sales. And again, it's a calculated number. It's not a yellow cell. We're not directly forecasting no plat, right? Because we forecasted the Ebitda, the DA, and the tax rate. Non-operating gains and losses equals the previous year. I'll make that yellow. So finally, I'm going to take these assumptions, I'm going to copy them, and I'm going to paste them out to 2021. And before I forget, save this file just in case Excel crashes. I hate to lose everything as we're going through this. All right, so now I have placeholders for the income statement, for these ratios, for the next 6 years, cells I can change in yellow, calculated results otherwise, that are basically just equaling whatever they were in 2015. Questions about that? All right, let's now go to the income tab and start building out the income statement. So we already have the revenue for Starbucks in 2016. So now what we're going to do is we're going to jump right down to Ebitda. So Ebitda for 2016 equals, from the ratios tab, 2016 Ebitda as a percentage of sales times, from the income tab, 2016 sales. That is the Ebitda as a percentage of sales, 5283.3. Yes? So just taking from the ratios, Ebitda as a percentage of sales, H6, times the 2016 forecasted revenue, H3 off of this tab. Okay? Same thing. Depreciation amortization equals ratios, 2016 depreciation amortization, so that's H7, times income tab, 2016 forecasted sales, 1,087.9. Operating income, calculated result. You can actually see the pluses and minuses over here on the left. So basically, Ebitda minus DA, 4195.4. So very quickly, we've just forecast the operating profit for Starbucks using the ratios. All right? We have to finish off through net income. Interest expense. As it explains in the book, best practice for enterprise DCF valuation is to assume a constant target capital structure. We're going to apply that methodology in the valuation model. So what does that mean? Capital structure is not changing, debt's not changing, therefore interest expense is not going to change. We're just going to leave it alone. So it won't affect the valuation whatsoever. It's really just to get a statement that balances. So interest expense equals previous year. Interest income equals previous year. FX gains and losses, 0. Too hard to forecast gains and losses because we don't know which direction currencies are going in the future. So therefore, we're not going to forecast them, and we'll assume companies are decent at hedging. So 0. Okay. Non-operating gains and losses equals, from the ratios tab, 2016 non-operating gains and losses, percentage of sales times income, 2016 forecasted revenue. Oh, did that in the wrong cell. Equals ratios, non-operating gains and losses times income 2016 sales. And I skipped over this one. Income loss from affiliates equals previous year. So if I had any gains or losses from affiliates, we'll just assume that they stay whatever they are. Right? So finally, pre-tax income. It's already been calculated by adding and subtracting the numbers above, so we can just copy and paste this over. Income tax expense equals, from the ratios, the tax rate we're forecasting for 2016 times, from the income tab, the pre-tax income. That's how much we would pay in taxes at 29%. So, income before extraordinary items is the pre-tax minus the tax. That's our after-tax income, $32.23 before extraordinary items. Here's the key to extraordinary items. 0. Yes. It's the income tax rate from the ratios tab times the income, pre-tax income on this tab. So H16. And then income before extraordinary items is H16 minus H17. All right, extraordinary loss, 0. Keyword there is extraordinary. If a company has a gain or loss that they say is one time, we're going to believe them, which means it doesn't happen in the future. So we don't forecast one-time gains or losses in the future. Right? So 0. So therefore, net income before minority interests equals the income before extraordinary items minus the extraordinary gains and losses. Minority interest equals previous year. Because we're not changing the capital structure, whatever they're paying in minority payments, we're going to assume continues. Net income equals the income before minority interest minus the minority interest. That's your net income. Dividends. Because we're not changing the capital structure, if the company has preferred stock and is paying preferred dividends, they're going to keep paying them. So equals previous year. Other adjustments, 0. Reason why? Other adjustments are changes that the accountants make to financial statements that don't impact cash. They're after tax. So therefore, they won't affect the valuation. And it's too hard to figure out what adjustments accountants are going to make in the future. So we're not going to forecast them. So that's why we're making it a 0. Net income available to common shareholders. Just take cell G25, copy and paste it over. Dividends, because we're not changing the capital structure, we're going to leave the dividend policy alone. Dividends stay constant. It doesn't affect the valuation. So in this case, equals negative 928.6. Now, finally, change in retained earnings equals net income available to common shareholders plus the dividends paid. Now, even though there's a minus over here, Bloomberg spits out dividends as a negative number. It also spits out cash preferred dividends as a negative number. All right. So some items it gives us positive numbers. Some items it gives us negative numbers. I happen to know dividends are a negative number. So that's why we're actually adding the dividends here. We do change retained earnings, even though it says subtract it, because we can't subtract a negative. It would be a double negative. So therefore, we're adding the negative dividends. But that would be our change in retained earnings off the income statement. Questions? Yes? Yep. I mean, you could do the math here, but the reason I said copied above is because we actually have to add the negative cash preferred dividends because it's going to come in as a negative number, just like the dividends paid. So it's easier to just copy and paste that formula. Okay. All right. Final step. Take 2016 copy what you just did, and paste it out to column M through 2021. So what we've just done, using the ratios as placeholders, is we've just forecasted Starbucks income statement for the next 6 years. So if the same ratios hold true, this is what Starbucks is going to do for the next 6 years. Which then leads to the TII. And I'll shrink this to make it easier to see. This was the balancing TFI or TII on the historical income statements. So since we use relative references, just like you did on your midterm exam, take 2015, copy it, go to 2021, paste, equals previous year plus 1 for the relative references. So I should now have balancing TIIs going through 2021. So that's the point. We forecast the income statement. The TII was matched to the income statement. So therefore, we can just copy the TII forward and it still becomes mapped. Or it still stays mapped. Yes?
For the income, when I dragged it out for 2017 to 2021, I just got number signs from the revenue.
I wouldn't drag. I'd copy and paste. Don't drag.
Yeah.
Oh, and then yeah, your columns might be too narrow.
Yeah, thank you.
Good point. Other questions? Pretty straightforward. Great. Let's move on to the balance sheet. Again, make sure you save along the way. I'd hate for you guys to get this far, Excel crashes on you, and you have to start all over again. Ratios for the balance sheet. These are the 2, 3, 4, 5, 6, 7, 8, 9 ratios in the balance sheet that we're going to forecast. Every one of these ratios is a percentage of sales. This is where we will differ from the book. In the book, they talk about using the balance sheet ratio that matches to the driver on the income statement. So for example, inventory cost of goods sold. For simplicity, we're going to tie every one of these balance sheet ratios to sales. Everything is a percentage of sales. So in this case, equals the previous year. Make it yellow. Copy. Paste. So we're just matching placeholders where everything equals last year's percentages for those 9 ratios. Then from this, we're going to create the balance sheet. Okay? So I'll go to the balance sheet tab. And again, I'm going to hide these columns just so it's easier for you to see what I'm doing. So again, this is the forecast balance sheet. So I'm going to separate this out. Equals previous year plus 1, relative references. So let's start with the ratios. The first ratio is accounts receivable. So I go to accounts and notes receivable, 2016 equals ratios, 2016 accounts and notes receivable as a percentage of revenue, times, from the income tab, 2016 revenue. And I'm going to change my formatting. One decimal place. All right, 837.7. Okay, inventory equals, from the ratios, inventory as a percentage of sales in 2016, forecast, times income tab, 2016 revenue. Other current assets equals, from the ratios tab, 2016 other current assets as a percentage of revenue, times income tab, 2016 revenue. Long-term investments equals, from the ratios tab, 2016 long-term investments as a percentage of revenue, times income, 2016 revenue. Net fixed assets equals ratios. Net fixed assets as a percentage of sales times income, 2016 net fixed assets. Sorry, 2016 revenue. Other long-term assets equals ratios, 2016 other long-term assets as a percentage of sales times income tab, 2016 revenue. Accounts payable equals ratios, 2016 accounts payable as a percentage of sales times income, 2016 revenue. Other short-term liabilities equals 2016 other short-term liabilities as a percentage of revenue times 2016 revenue. And other long-term liabilities equals 2016 other long-term times income, 2016 revenue. So very quickly, we've just taken those forecasted 9 ratios and we created the associated dollar amounts for 2016. Now, what we now need to do is we need to finish up the balance sheet, get it to balance, and make sure there are no circular references. If you have a circular reference, you have a flawed, invalid model. So we're not allowed to have circular references. So I'm going to show you how to get a balancing balance sheet that doesn't have a circular reference. To do that, we're going to finish forecasting the liabilities and equity side of the balance sheet first. So let's start out with equity. Yes? So we're going to start with equity first. Right? So starting with total preferred equity equals previous year. Because we're not changing the capital structure, whatever equity they have for preferred shareholders, we're going to leave alone. Minority interest, same thing. If the company has any minority shareholders, we're not going to change the minority shareholders' interest in the future. Equal the previous year. Share capital, equal the previous year. We're not going to issue any new shares. We're not going to buy back any shares. We're going to leave the share account alone. And finally, retained earnings equals previous year retained earnings plus income tab 2016 change in retained earnings. So H27, which was the final number at the bottom of the income tab that we had forecasted. So given that change in retained earnings, the retained earnings should grow to $8,067.9 million. So last year, plus whatever new retained earnings from the income statement this year, add them together, that becomes your new retained earnings balance. Then, what we can quickly do is we can come down here to total equity, and we can sum these 4 items, and that becomes our equity for the firm. Debt, short-term borrowings, equals the previous year. We're not going to change the debt since we're not going to change the capital structure. So current liabilities equals the sum of those 3 things. Long-term borrowings equals the previous year. Again, not changing the capital structure, we're going to leave the long-term debt alone as well. Pension liabilities, if a company has one, equals the previous year. So whatever pension liabilities you have. Anything else, you don't add to. NPV 0. Under U.S. law, companies can't have long-term pension liabilities that are unfunded anyways, so we're just going to assume they won't grow. Okay. Long-term liabilities equals sum of these 3 long-term liabilities. Total liabilities equals current plus long-term. Liabilities and equity equals total liabilities plus total equity. And that becomes our liabilities and equity forecast for SBUX, 15,444.8. Now, it's very important to get a balancing balance sheet. Again, if we don't have a balancing balance sheet, we will have a flawed model. So I'm going to show you how to balance your balance sheet. Go to your assets, 2016, equals liabilities and equity. Now, we have a balancing balance sheet. We force the balance sheet to balance, right? Which means we're going to have to put in what's called a plug, right? In order for the assets to actually add up to that amount, we're going to have one item that's a plug that we're going to solve for to actually make it add up. The plug is excess cash, right? So we're going to plug for excess cash. So we need all the other assets except for excess cash, and then we're going to solve for it. So here's how we're going to do this. Operating cash equals, off the assumptions tab. Right now, cell B3, it's 2% of revenue. So 2%, cell B3 off the assumptions, times income, 2016 sales or revenue. Now here's the thing. On the ratios tab, everything is forecast year by year. On the assumptions tab, there's only one assumption for all the years. Therefore, I want to make this an absolute reference. So for cell B3, $B, $3. Final one down here is Goodwill. We're not forecasting any acquisitions in the future. Too hard to do. So whatever Goodwill the company has, they're going to keep. If they write it off, it's impaired, which is a non-cash expense, so it doesn't matter the valuation anyways. So right now, just equal the previous year's Goodwill. Okay? So those are the last of the items. I can now solve for excess cash. So equals total assets minus everything else. Minus operating cash, minus accounts receivable, minus inventory, minus other current assets, minus long-term investments, minus net fixed assets, minus goodwill, minus other long-term assets. If I did that right, I would have solved for an excess cash balance, and more importantly, I don't have a circular reference. If you have a circular reference, you made a mistake. Right? So finishing up the categories, total current assets, sum the above, total long-term assets, sum the four long-term assets. And if I want to do a quick check, current plus long-term, balance sheet balances. Because the plug worked. Of course, it's going to make the balance sheet balance. I don't need this cell, but that's the point. I now have a balancing balance sheet. I then take 2016, select the column, copy it, and paste it forward to 2021. So very quickly, we've just forecasted 6 years of balance sheets for SBUX. Questions? We got 6 years of income statements. We now have 6 years of balance sheets. Which means, if we go to TFI, and I'll shrink it just so you can see what I'm about to do. Take 2015 TFI. Cancel. Undo. Take 2015 TFI. Paste it out to 2021. So I now have TFI going through 2021 balanced. Because I forecast the balance sheets, they're mapped. I now have forecast for TFI. Then I go to my CFI. Take, again I'll shrink it just so it's easier to see. Take 2015, paste it to 2021. I now have balancing CFI. And the number you want to get, 980.3. Balances for all 5 years. If you got to this point, you've just completed homework 7. save, upload your file, done. If you didn't, this is where you need to get to by Wednesday, 10 a.m., because I will not be posting a solution, but we will pick up at this point, and then we will continue building the next part of the file from here. Again, questions about anything we did today? Yeah.
I just see the balance sheet right now.
Which part?
And then 2016.
That's 2016.
Thank you.
Yes. Question? You're going to have it ready by next week. So it will be part of your homework next week. So if you don't get it done by Wednesday, that's okay, but you will have to have it done sooner. So I would recommend doing it sooner rather than later. Because once we finish with SBUX, one of your homework assignments next week is going to be another company. And you're going to have to quickly do the other company. So you're going to have to do it. But for Wednesday, no. Your homework 7 is just this file. Right. Other questions? All right. Here's something conceptual I just want to mention. Look at CFI and notice CFI does not change and stays at 980.3 from 2016 through 2021. Why? Why does the CFI not change for those 6 years? Yeah. Yeah, we kept the debt and equity the same, so we didn't change any of the financing flows. All right, so therefore, if we don't change any of the financing flows, then the CFI is going to stay the same. But SBUX continues to generate money. They're making profits. So what happens to all their profits? What happens to all the cash profits, specifically the free cash flows they make, that they're not paying out? Yeah. They go to excess cash. So what you'll see is that in the model, the excess cash for SBUX, which would be this line, continues to go up. So here's the thing. When we do the valuations, and this is a preview of this, we're not forecasting dividends. We're not forecasting stock buybacks. But the proxy for what they can be is the excess cash. So that's the whole point. And that was part of your midterm question, which is if I treat the excess cash as the eventual payout, then it doesn't matter. It doesn't matter whether I give it to you as a dividend or a stock buyback. What I know is this excess cash is truly the future dividends and stock buybacks, right? And it doesn't impact the valuation in terms of the free cash flow, right? Because it's already taken into account by the increase in excess cash over time. So if you take a company like Apple, which has over $200 million of cash right now sitting on the balance sheet, if that's truly excess cash, then the investors have already factored in that amount of cash into Apple's valuation. So when Apple buys back its stock, it doesn't really change the enterprise value of Apple. Now, it might change the earnings per share of Apple because there's fewer shares outstanding. They can manipulate EPS, but they can't manipulate the actual value of Apple because the excess cash is already factored into the enterprise valuation. But nonetheless, this is one of the key things, might be a final exam question, which I've asked before, like why wouldn't the CFI change? The CFI changes only when the debt or equity payments change. And we have all that constant, so therefore you get a constant CFI. All right, that's not part of your homework 7, but it's a good illustration of the model. And here's the key. If you got the 908.3 or 980.3, you probably got it right. If you don't have it, make sure you get to that before you submit it, because this is going to be the file we're going to check. And this is where we're going to pick up in the next class as we continue building out the valuation of SBUX. Questions about anything again? All right. So as I said, I recorded this class in video.